A little over a week ago, millions of people watched SpaceX go public on the NASDAQ. The ticker was SPCX. The IPO price was $135. And on day one, the stock jumped to $161, a 19% pop in a single session. Financial news channels were celebratory. Social media was electric. People who had waited years to own a piece of SpaceX finally could. And then something interesting started happening. The stock climbed past $200, touching an all-time high above $225 within days. Then it started falling. As of right now, it has dropped more than 20% from that peak, sliding for multiple sessions in a row with one single day seeing a drop of nearly 9%. Now here is the question nobody in the mainstream coverage is asking. Is this just normal post-IPO volatility, or is something else beginning? Because buried inside a public document that SpaceX filed with the SEC, a document anyone can read, a document most people never will, there is a calendar. And on that calendar, there are specific dates. And on those specific dates, things are going to happen to this stock that the people celebrating the IPO pop had absolutely no idea were coming. By the end of this video, you will have that calendar. You will understand exactly what is on it, why it was built this way, and what it means for anyone holding SPCX right now or anyone thinking about buying in. I am not here to tell you SpaceX is a bad company. It is not. It launches more rockets than entire nations. Starlink serves over 10 million customers across 150 countries. The defense pipeline is deep and growing. This is not about the company. This is about the deal. And the deal and the company are two completely different things. Before we get to the calendar, you need to understand one number. SpaceX went public at a valuation of $1.75 trillion. Last year, the company brought in about $18.7 billion in revenue. That means you are paying roughly $94 of valuation for every single dollar of sales this company generates. 94 to 1 for a company that is currently losing money. Now, to give you a sense of how stretched that number is, one of the most respected independent research firms on Wall Street ran a detailed valuation of SpaceX using the actual prospectus numbers. Their conclusion? The company is worth closer to $780 billion. That is more than 50% below the price it went public at. So the valuation is not pricing what SpaceX is today. It is pricing what SpaceX needs to become over the next decade. And it is asking you to pay for that future in full upfront today. That is the price anchor. Hold on to it, because the calendar we are about to look at only makes sense once you understand how much optimism is already baked into the current price. Here is what most people know about how IPOs work. A company goes public. A lockup period begins, usually 180 days. Insiders cannot sell their shares during that time. When the lockup expires, they can. Simple enough. But here is what most people do not know about this specific IPO. SpaceX did not build a standard lockup. What they built instead is something far more complex and far more deliberate. Instead of one single date where insider shares become eligible for sale, SpaceX created a staggered release schedule. 5 separate tranches unlocking at fixed intervals, 2 additional cliffs tied to earnings reports, and one trigger, and this is the one that should make you stop, tied directly to the share price itself. Let me read you what the prospectus actually says about that trigger. If SPCX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares unlock for sale early. Read that again slowly. 30% above the IPO price. That is $175.50. In the days following the IPO, the stock traded well above that level, at one point more than 60% above the IPO price. Based on that trading pattern, this trigger has very likely already fired. Think about what that trigger actually means. The moment the stock ran above $175 for 5 of any 10 trading days before the first earnings report, an additional 10% of insider shares became eligible for sale. The pop that everyone celebrated on day one, the 19% jump, the headlines, the cheering, the social media posts, that pop was not a victory lap for retail investors. That pop was the starting gun for early insider selling. The harder the stock ran in its first weeks of trading, the faster the trigger was activated. The faster the trigger was activated, the more insider supply entered the market ahead of schedule. And here is the part that does not fit the narrative you have been sold. The insiders who benefit from that trigger, the early employees, the venture firms, the executives who have been holding SpaceX shares for years waiting for exactly this moment, they knew the trigger number before the stock ever opened for trading. It was printed in the prospectus. They could plan around it. The retail investor watching the stock climb on day one had no idea the clause even existed. Same stock, same document, two completely different deals. Now let me show you what is actually coming, because the trigger is only the beginning. Picture a calendar on the wall. June 12th is day 0. SpaceX just went public. About 5% of the company is actually trading. The other 95% is still locked up. Now walk forward. Friday, August 21st, day 70. The first of 5 staggered tranches unlocks. 7% of insider shares become eligible for sale. Thursday, September 10th, day 90. Second tranche, another 7%. Friday, September 25th, day 105. Third tranche, 7%. October 10th, day 120. Fourth tranche, 7%. October 25th, day 135. Fifth tranche, 7%. That is 35% of insider shares released across 5 dates between late August and late October. And those are only the time-based unlocks. 2 more cliffs sit in between them, tied to earnings reports. The first fires 2 days after SpaceX reports its first quarterly results as a public company. That covers the quarter ending June 30th. That earnings report is scheduled for August 6th. 2 days after it lands, an additional 20% of insider shares unlocks.
20% in a single event, on a date that is not fixed in advance, on a date that most retail holders will not be tracking. The second cliff is even larger. 2 days after the Q3 earnings report, covering the quarter ending September 30th, another 28% unlocks. Then comes December 9th, day 180, the standard lockup expiration. Whatever restrictions remain, lift completely. Add it all up. 5 tranches at 7% each, 35. Q2 cliff, 20. Q3 cliff, 28. That is 83% of all insider shares released before the calendar even hits day 180. By mid-December, 6 months from the IPO, every restriction on the staggered schedule will have lifted. Every insider who wants to sell will have had multiple windows to do so. And then there is one more date worth marking. June 13th, 2027, day 366.
That is when the founder's lockup ends.
Every headline after the IPO celebrated the fact that the founder committed to a full-year lockup. And on the surface, that does seem like a vote of confidence. But look at what it actually means in context. The founder holds majority voting power. His net worth does not depend on selling shares in the next 12 months. A public commitment to stay locked costs him nothing and generates enormous goodwill. Everyone else, the early employees who joined before SpaceX was worth anything, the venture firms that funded the company through its riskiest years, the executives 1 tier below the very top, they are all on the staggered schedule. Their first window to sell opens in roughly 64 days. By the time the founder's lockup even begins to lift, everyone else will have had a full year of exit windows to sell into retail demand. The person at the top stays locked and gets the headlines. The people in the middle get multiple exit doors over the next 6 months. The person buying SPCX on their phone watching the ticker is the demand that those exit doors are pointed at. Same prospectus, same company. 2 completely different deals, depending on which side of the lockup you are sitting on.
Here is a question worth sitting with. Why did SpaceX build a lockup this complicated? Every other major IPO in recent history used a simple 180-day cliff. Rivian used it, Uber used it, Palantir used it. Why does SpaceX have 5 tranches, 2 earnings cliffs, a price trigger, and a separate founder lockup? 3 reasons. And once you see them,
the design stops looking neutral and starts looking deliberate. The first reason, cliffs make headlines. When Rivian's lockup expired, the stock dropped 20% in a single day after Ford disclosed it would sell its entire stake. When Uber's lockup expired, the stock hit an all-time low on the exact expiration date. When Palantir's lockup expired, Peter Thiel and other insiders sold tens of millions of shares in a single session, and the stock fell 13%. Cliffs are visible. Cliffs are painful. Cliffs get covered by every financial outlet on the planet. A staggered schedule diffuses that pressure across a dozen smaller dates that no reporter will write a headline about, and no casual investor will be tracking. The second reason, the staggered schedule accelerates float growth, and float growth has a very specific benefit in this market right now.
Under a rule that took effect just before this IPO, companies can be added to the NASDAQ 100 in as little as 15 trading days after listing. And for companies with a free float below 20%, the index treats their float as if it were 3 times its actual size. SpaceX's 5% float gets weighted as 15% in the index. That means hundreds of billions of dollars in passive funds that track the NASDAQ 100 are forced to buy SPCX, not because they chose to, not because they analyzed the valuation, but because the rules require it. And every tranche that unlocks grows the float. Every float growth event pulls in more forced institutional buying. The design creates its own demand. The third reason is the simplest. The insiders have a calendar. They can read the exact dates when their shares become eligible for sale. Day 70, day 90, day 105. 2 earnings cliffs at unknown but predictable intervals. A performance trigger at 175.53. They can plan around all of it. The retail investor buying on day 1 has no calendar. They have a stock price, a news headline, and a feeling. That asymmetry is not an accident. It is the product.
Now let me show you what has actually happened when this pattern played out before. Palantir went public in September 2020. Retail enthusiasm pushed the stock from around $10 to nearly $40 by early 2021. Then the lockup expired. Insiders, including Peter Thiel, sold tens of millions of shares into the premium retail had built. The stock fell 13% in a single session. The expiration date was printed in the prospectus from day 1. Almost nobody buying at $38 was tracking it. Rivian went public in November 2021. The opening day was one of the most exciting in recent memory, up 22% above the IPO price. A lot of buyers took that pop as confirmation they needed to get in fast. 6 months later, Ford disclosed it would sell its entire stake on the lockup expiration date. The stock dropped 20% in a single day. Over the year that followed, it fell 67% from its peak. Uber went public in May 2019 at $45. By the time its lockup expired in November, the stock was struggling. On the exact day insiders were finally allowed to sell, it hit an all-time low, 40% below the IPO price.
The pattern is consistent. The higher the speculative premium at IPO, the more painful the unlock events tend to be. SpaceX went public at 94 times last year's revenue. That is the highest premium of any major IPO in recent years. By that measure, the room for things to get difficult as these tranches unlock is unusually wide. Not because SpaceX is a bad company, but because the expectations already baked into the price leave almost no margin for anything to go wrong.
So where does this leave you if you are genuinely drawn to this company? Because none of what I just showed you is a reason to write SpaceX off forever. It is an extraordinary business. Starlink's trajectory is real. The defense contracts are real. The launch business is real. This is about timing and price, not company quality. There are 2 loud options most people pick. The first is to chase the momentum. Buy now at whatever the current price is before the tranches start unlocking in August. This puts you in the weakest seat in the house, absorbing supply from people who have been waiting years to sell, at a valuation that already assumes a near miraculous growth trajectory. The second is to swear off SpaceX entirely on principle and never look at it again. This trades away a potentially great long-term business over short-term deal mechanics.
The third path costs nothing but patience. Between now and December 9th, every single one of these events will have played out. The Q2 earnings will have landed, real numbers, not projections. The Q3 earnings will have landed. All 5 tranches will have unlocked. The price trigger will have resolved one way or the other. The forced NASDAQ buying will have run its course. By mid-December, the price will reflect 6 months of actual operating results instead of the opening weeks of pure excitement and momentum trading.
That is the price worth evaluating, not the one on a screen that has already swung more than 20% in either direction within its first 2 weeks of trading. Here are the dates worth marking, not for trading, for watching the story unfold. Late August through late October, the 5-tranche window, each one releasing 7% of insider supply. August 6th, the Q2 earnings report. 2 days after it lands, 20% of insider shares unlock. Somewhere between mid-October and late December, the Q3 earnings report. 2 days after, 28% unlocks. December 9th, the standard 180-day expiration. The last 17% of restricted shares becomes free to trade. June 13th, 2027, the founder's lockup ends. That is the real calendar. It was sitting in a public document the whole time. The advantage was never about access. It was about who read it.
The number on a stock ticker is loud. A calendar full of specific dates is quiet. The number changes by the hour. The calendar runs for a year. Most people let the loud thing make their decisions. The people who consistently do well in markets tend to be the ones who found the quiet thing first. If this kind of thinking, looking at deal mechanics before deal headlines, reading the documents before reading the price action, if that resonates with you, subscribe to Matt Finance. This is exactly what we do here. We find the part of the story that the hype cycle skips over, and we break it down until the math is clear. And if you want to see us apply this same lens to a completely different question, which actually builds more wealth over 20 years, real estate or stocks? That breakdown is on this channel right now. The math in that one will surprise you. See you in the next one.